This is Scott Harms, co-founder of Turbadium, here with a special guest on our 7th episode of Tokenize This. I have our other co-founder, Andrew Gajunas, on the line, and we're joined today by Assistant Professor James Caton.
Thank you, Scott. I'm an assistant professor at North Dakota State University Center for the Study of Public Choice and Private Enterprise. I'm also a Sound Money Fellow at American Institute for Economic Research. Of course, anything I say here today is of my own opinion, my own perspective. So I'm not here representing them, but this is sort of the area that I hang out in intellectually, you could say, at the crossroad between policy, government, and economics, especially macroeconomics, monetary economics.
So, Jim, given that lengthy pedigree and you're working in monetary policy and macroeconomics, maybe we start with something a little simpler, and you can give us your definition of money.
Well, Andrew, that's a good question, and I think that's something that is not really open for debate about what money is fundamentally. We think of money, if I say money is a medium of exchange, you shouldn't get any pushback from anybody if you say that. Maybe there's some people out there who will, but by and large, we think of money as that thing that you hold, it has value, and you use it to get the stuff that you want. Most people, because they trade their labor for money, they think of money as what they earn when they work, and then they use that money to turn the value that they've earned into real stuff. Right? And you can imagine, like, fundamentally, what is the problem that we're dealing with the origins of money? And you can actually, I've written a fair amount about this, and a number of my colleagues have, thinking about the evolution of money and the meaning of money. So you can imagine that we're in an early society with no money. And Carl Menger actually presented this theory originally, the evolutionary theory of money, in the late 19th century. He said, well, imagine that there's a lot of goods that could be traded. And if you are a farmer of, say, just a few crops, if you grow wheat and you have an apple orchard, and maybe you grow some grapes or make some wine, it's going to be very difficult to trade the goods that you produce directly for what you want. Now, it's possible, right, if you live within a small community of farmers, maybe you could set up arrangements to trade with one another, and you can survive that way. But the reality is that it's a lot more efficient once you get money to produce, as a farmer or as really producing anything. Because now you can specialize in one good. Remember, this is Adam Smith. He says, well, what's really great about modern society or about exchange is it allows us to specialize, create value, become very good at creating value, say of a particular good, do that very efficiently, and then be able to sell those products. Again, we're exchanging that for money and then trading that for some other goods. So the money gets over this problem of having to find another party who has what you want and you have what they want. Right? This is what we call the double coincidence of wants.
So, and that actually introduces some new challenges as well, does it not? So, for example, if we're going to use a medium of exchange, both parties or different parties need to agree upon that medium and what the valuation of it is, correct?
Oh, absolutely. And you point to really what is the next step. Whenever I teach money in my macroeconomics courses, right, we start out, we say, well, what is the essence of money? The essence of money is that you're going to use it to exchange it for other stuff. Right? So when a good becomes money, typically it has some use value and then some exchange value, or at least in the earliest monies before the monetary system really transformed. When people don't have some concept of what money is, they say, well, I have this good, it has value, and other people want this good. And so money takes on characteristics. So we want money to be a good store of value. Right? Or in other words, we want it to be durable.
Right.
We want money to be easily divisible. And so that we can measure it and then exchange it and not lose value whenever we exchange, right? So you could imagine if you're bartering for everything, let's say that you're primarily a dairy farmer. So you raise cows, and yeah, you could trade your milk, But when it comes to the value that's invested in the cows, it's hard to split up the cow. You don't want to. If you chop a limb off the cow, it's not like you're trading off one quarter of your cow's value, right? Once you chop off one limb, you've got to chop off all the limbs of the cow. But we do, which actually cows did serve as money, or at least serve as a store of wealth amongst large wealth holders, right? You could exchange cows. That would make sense. But cows don't work really very well day to day when it comes to trying to use them as money. So we end up with different commodities, right? And we've seen in history things like tobacco and tobacco notes be used. And we see ultimately most economies have converged upon, bronze, silver, gold as money, at least before governments began getting involved and then building fiat money systems that moved us marginally away ever so slowly from monetary standards.
So a couple of really interesting points. I think we'll come back to chopping up the cow in a little bit, which I think is a interesting paradigm, which tokenization, I think, will start bringing a play into that.
Tokenized cows?
Yeah, tokenized cows too. Why not? You don't have to chop up the cow in real life to own just a piece of it, I think. But before we get to that, though, so just to segue into the evolution of money and how it started with being agreed upon store of value. You just mentioned durable, divisible. So now we've got the entrance of say these cryptocurrencies that come in. And the first generation cryptocurrencies like Bitcoin, for example, are essentially these artificial pools of scarcity created and willed into existence, but they do serve as money. They do meet some of the criteria of that, correct?
Absolutely. There might be a question of so what is the value of cryptocurrency? And we can certainly point to some services that cryptocurrency is providing. There's actually an interesting conversation between Lawrence White and Jeffrey Rogers Hummel on a Liberty Fund paper. I can't remember the name. Maybe something along the lines of just cryptocurrency. But and Jeffrey Roger Hummel makes the point that cryptocurrency actually provides a service. It's not that it doesn't have any value, but if you're trying to, say, hide your identity and exchange on the dark web, for example, right, then cryptocurrency is actually providing tremendous value to you. And it fits the characteristics of money that we like. Again, it's divisible, it's scarce, things that are very important. It's not going to lose its value. We know Bitcoin is capped. Now, that doesn't mean that you can't have a fork. Like we saw the Bitcoin Cash fork trying to deal with some problems, but that becomes a different currency and a different issue. And unless people value the new fork, that shouldn't really affect the value of the existing cryptocurrency, or at least we could talk about the complexities of how that might. But we do see that cryptocurrencies can and do act as money. Really, the challenge is looking at legal issues about what's inhibiting cryptocurrencies from acting as money.
Well, and I think, obviously fiat has monopolistic legal tender laws, and reserve currency status has got an established so it's got a bit of a head start over things like cryptocurrencies. But you mentioned, for example, even scarcity, right? And I use the word too, kind of loosely, which, in these first generation cryptocurrencies, they enforce through a model where they're saying there's only X ever going to be in existence, and that's it, right? But that in itself, I think, causes issues in when you mention stable store of value, because now, the paper you wrote on the dichotomy of monetary policy that kind of showed that the supply demand equation, you're locking the supply. So I think that's kind of like what brings us some of the volatility we see today. Is that right?
Well, so right now the market is going to be inherently volatile simply because people aren't sure what cryptocurrency is, which one's going to be the dominant cryptocurrency. So there certainly is a lot of volatility. Now, we could say, does rigidity in the supply tend to increase the level of volatility, right? Or in other words, if increases in demand for cryptocurrency was met with some increase in the actual quantity supplied. These are the economic terms we use, right? If people are willing to pay more for a cryptocurrency, and that cryptocurrency is able, within constraints, to create more of that cryptocurrency, right? Will that offset the price effects? And the answer is yes. We saw this under the gold standard as well. In years where there's a high level of demand for the gold standard, and I've written about this a fair amount, when there's high levels of demand for gold, then gold production would respond. And if gold production was unable to respond immediately, then investors would put their money into technology and try to find ways of increasing the efficiency with which they mine gold. Right? And we saw this effect also recently. Commodities just operate in this way, and money is a commodity like anything else. With oil, right? When the price of oil increased, we had the development of fracking technology, and it started out being very expensive, but $140 a barrel will get you there. And then as time's gone on, now we're sitting at $70 a barrel, and that's about the profit range, and the cost continues to drop. So, we see these effects in a lot of different markets. Markets for money are just like any other market.
Yeah, so and that, you make some good points. So, for example, even like the Alberta oil shale sands too, as the price of oil dropped, all those production facilities kind of dropped off the books, and it was no longer viable to produce a barrel of oil until they could improve the technology to produce it at a profitable means from those sources. So these are free market mechanisms kind of jumping in and helping regulate the supply of the commodity. In the case of cryptocurrencies, what we've seen so far are two primary approaches. One would be the fixed supply, which is that of say, for example, Bitcoin. So there's only going to be X number ever in existence, and nothing can change that. And then another one are these introductions of some of these stable coins that are using algorithmic means to expand the monetary supply and contract it based on demand. Now, I'm kind of curious to hear your thoughts on that side. Now, obviously, on the fixed supply, let's address that first. Obviously, there's a reason behind that, and they I think one of them, in my opinion, is they just didn't want to have some central authority, the power to manipulate the monetary supply, right? Does that make sense to you? Like that? Why?
Yeah, I mean, this certainly is the advantage, and I think the desire of a lot of people to use cryptocurrency is saying, well, it's an alternative that we can trust, and trust is huge. And with the blockchain more generally, the blockchain's facilitating trust. Now, it's an interesting question, in terms of like the effects of not having a responsive supply or quantity supply to adjust endogenously to the level of demand. When we say endogenously, it just means for it to respond to demand as opposed to staying fixed. Now, in a world where we're stuck on one currency, this would really be a problem. Now, I don't know, of course, what direction the cryptocurrency markets are going to go, but it's not unthinkable, right, that you could have competing currencies, and you could actually have maybe one or two dominant currencies and a handful of, say, second-tier currencies, assuming that these can become successful. There's a lot of barriers in getting to that point. But where simply by adopting a second, say, dominant currency or having all of these alternative currencies to go to allows the market to adjust the total quantity of money desired, right? But
Oh, I lost you guys. Hold on a second.
That ends up winning out is a system that is very responsive. That's possible, but again, this is up to the market to decide. Markets tend to select those goods, or the providers of goods, select for those producers of goods that tend to do it at lowest cost, right? And if having a flexible money stock whose quantity adjusts according to changes in demand, right? If that's the lowest cost means, if that's going to bring the greatest benefit to consumers for the lowest cost, then that's what we expect in the long run to win out. But again, we're at very early stages, in terms of the stages of innovation. I think we're barely clearing into the second stage from those early innovators to those early adopters.
Yeah, no, I mean, and I think the algorithmic quote unquote stable coins have a ways to go yet until they figure out a means to do it without either forcing the hand of the currency holders. So, some of them force you to buy future bonds of the cryptocurrency if it starts falling below $1 to support the price. And there's a number of these automatic mechanisms I think kind of shut out the free markets and shut out free will to enforce a peg against some kind of external measurement like a US dollar versus something that's more adaptive like the commodity money, that as the price goes up or down, the market reacts by increasing the supply or demand simply based on profit. So, and that brings us maybe to like cows, for example, or any real world asset that's non-divisible. So before, if you wanted to sell, part of a cow to use it to buy a latte or something, like as you mentioned, you can't chop up the cow and give them a hoof, right, and expect it to get some kind of value. With tokenization, I think being able to create digital representations of equal ownership of that particular commodity, this would actually allow the markets to react, right, to add additional supply or reduce it based on the price of the currency.
Right. So this is actually what's exciting, is to see value from assets actually be able to be converted into money.
Yeah.
There's a lot of value in the marketplace, and you see it in modern money markets with lending. Lending works in this sort of way, is that a bank is willing to lend to you as long as you have some minimum capital value, and then they're going to lend you X amount of dollars because you have property that can serve as collateral, right? And then you take that money, you put it back into the bank, and then the bank lends that money again. And so we already have something that in the system that operates endogenously to regulate the quantity of money according to demand. Now the challenge or the problem arises like during a credit crisis. What do you do? No banks want to lend, and even if you have property that's valuable, we're not quite sure how valuable it'll be after a deflation due to a credit crunch or something like this. But this is all to say that you see these mechanisms in operation already. The really challenging thing, again, is going to be for markets to deal with regulations that are preventing cryptocurrencies from being traded like money. It's, every time you exchange your Bitcoin for another cryptocurrency or you sell it, you have to register it for capital gain and then pay that cost. Right? Suddenly the benefits of using that as money go away. Right? So that's to say, as it stands right now, until legislation starts to adjust, the tax code adjusts, and we'll see which countries do it first. The prime beneficiaries of cryptocurrencies, I think, are going to be countries where the governments just aren't really functioning that well, or aren't able to do a good job of collecting taxes and of having that oversight. So you see Bitcoin being used in Venezuela, anywhere where there's a hyperinflation. It's like cryptocurrency. Worst case, cryptocurrency is this sort of bottom rung that your society can't fall below, because now we have this alternative. Now, I think, right, it's a matter of time for governments to see the benefits of this, of having a dynamic economy, having a dynamic money stock, and so forth. And there's a lot of different governments around the world, so you just need one decent-sized player to start picking it up and seeing that. And you're already seeing, on different margins, governments are attempting to work with the blockchain and cryptocurrency. I can go on about blockchain and the mechanisms for money creation that are really exciting right now. Like, we are at the forefront of something, not just cryptocurrencies, companies that think of themselves only as providing cryptocurrency, but say like your company, in some ways the blockchain becomes a deed. And actually, there's a lot of opportunities in a lot of different companies that are moving in this direction, using the blockchain as something like a deed, using smart contracts with blockchain. And so we're already seeing agricultural commodities being used with the blockchain and smart contracts, right? Louis Dreyfus, for example, in January, executed a contract using the blockchain and RFID. When their delivery was made, everything was automatically executed, and they seemed to be pretty happy about the results. Right? So there's tremendous possible value here. Likewise, Kodak has created a cryptocurrency. Now, who knows how successful this may or may not be, but maybe the blockchain, tokenization, cryptocurrency, these are means of starting to privately build a set of intellectual property rights, to some extent. Who knows, like, what the possibilities are, but it seems like just, from a bird's eye view right now, seeing everything that's going on, that there's a lot of potential for value creation, and from that potential for money creation. And there's, the competition is going to work out which of these combinations is the best one.
Yeah, that's interesting. As we look at money and today's fiat money, there's borders. There's a lot of borders in today's fiat money, obviously. And what do you think cryptocurrency does to really allow a borderless transfer of data as a currency?
I mean, so we already see this with Ripple. Banks are moving to Ripple. This is sort of their consortium. And historically, this makes sense. Banks clear accounts against one another, and they want to find the low-cost means of clearing accounts with one another. And it seems the Ripple network has been that for them, and maybe banks in terms of XRP are interested. It's hard to say. Right now, the network is what seems to be at play. That's really interesting, because what is this? It's cross-border payments for very low costs. And again, with cryptocurrency, it's very cheap to do this, and you have anonymity. Right? So the anonymity question might come up between banks and governments when this is going on. Right? Governments don't like to be out of the loop. Banks are big players that can be more easily regulated. So that seems like it's going to be maybe its own sector. I don't know. But we definitely already see the move toward using cryptocurrency and the blockchain for cross-border payments. The future of that, or how that's going to turn out in the long run, I'm not exactly sure.
Well, do you think that this might be a out there question? Do you think fractional reserve banking has a future? So right now, Ripple's helping these centralized institutions do cross payments, but in a truly decentralized fashion. If we close that trust gap and we reduce the need for some of these intermediaries, you even see those banks playing a role. For example, in the credit crisis, well, if everybody's using their assets as money, they don't need credit, do they? Right?
Well, so this is a real challenge in thinking about future directions with this. I think the markets are going to price everything, and odds are there's going to be some marginal gain from fractional reserve banking and borrowing, some marginal gains from money creation through the blockchain, assuming that takes off. And usually what happens in the marketplace, you have an innovator and say, this is the way, and this is going to change everything. And I think blockchain is going to change everything. But what tends to happen is the strategy will come and take a prominent place in the market and find its niche alongside everything else. Deposit banking historically has been with us. People trust it. And I think blockchain might be a way of really stabilizing this fractional reserve system. And I think with modern finance, this could tend to be a very beneficial development. You think about exchange traded funds. What's the difference between an exchange traded fund and a fractional reserve bank? And David Glasner has actually done a lot of good work on this. He wrote his book, Free Banking and Monetary Reform, covers this issue. He says, well, ETFs are run proof, because if you have your money in an ETF, which essentially the blockchain is going to operate a lot like an ETF. You put your money into an ETF for gold, for example. What happens when you sell your share of ETF for gold? Well, it's not that the reserve ratio has gone down, it's that the price goes down. The price is doing the work. Everybody experiences the valuation. As prices fall, it's not like there's an incentive to continue selling unless you think there's going to be some feedback. But at some point, there's a bottom that these things will reach.
That's interesting.
The problem is that as people plot their money, the level of reserves compared to the level of liability is changing, or that ratio is changing. Right? That's what we call the reserve ratio. So if you pull your money out of a fractional reserve bank, then the top part of that fraction, the quantity of funds that are deposit or that are reserves over the total amount of deposits that the bank has, right? That number is going to go down, and the bank has to respond by, say, lending less, and that's where we get our systematic problem. ETFs, again, solve this problem by just simply having a drop in price. Blockchain, I think, will be the same sort of thing. And if we have a credit crunch and a blockchain, asset can
Lost you guys again.
It's not just that if there's a crisis, it's not just that you're holding investment is in a blockchain just to hold it as a store of value, but if it can actually be used as money and the transactions costs are sufficiently low, then during a crisis when people are demanding money, the value could actually increase. So this is where I think there's a lot of potential. We've already, the financial system is not really taking advantage of the moneyness of commodity or of commodity ETFs. So we already have potential for this in the market. Now blockchain, especially because of anonymity, is I think could effectively, maybe even ahead of changes in the legal system, actually make that a reality. And we'll see. It's hard to say up front, but this potential to have an asset that's low cost use for transaction, assuming capital gains tax doesn't make it too expensive to use, is going to have an offsetting effect during a credit crisis. People will be able to go to those.
And you bring up, on the capital gain side, I think that's why you see the popularity of stable coins right now, because if you can stay within the crypto realm, often you can avoid that measurement back into fiat and say that, well, it was all within the system, so therefore I didn't extract any kind of capital gains until I go back out into the U.S. dollar, so they can kind of set a valuation. Because when they try to track, well, how much money did you make when you sold your Bitcoin? Well, what was the price, right? And the exchanges that you do it on might have a price that you got for a different currency. But what valuation do you use? Because everybody's got a different price for each coin, right? You go on different exchanges. There is no central point of truth saying the price of a Bitcoin is X or Y, right?
Yes.
So you've seen that, like, stable coins are trying to create this little refuge within the cryptocurrency space where people can keep their money in crypto and yet go to some non-volatile means temporarily so they could hold on and use that to play the market swings, right?
Yeah, right. So this is going to be a difference between what we call de facto or de jure, or in other words, legally, if you transfer your cryptocurrency into anything else, you've got to register the capital gains tax. That's the system. Now, of course, monitoring costs are very high in a system where there's a high level of anonymity. So we're already running into the problem that, I think the large majority of people that have operated in the cryptocurrency space this year did not register their activity for taxation.
Yeah, they said, IRS said they were mostly.
But the government, it's very difficult to have oversight in that space. And not only is it very difficult to have oversight in that space, but it's very costly to even try to figure out what your payments are going to be. And I've talked to people who have been dealing with this. They said, yeah, not only did I get hit really hard on the level of taxes that I had to pay, the people I've talked to that actually went through the process say it was really expensive. The government got a lot of money out of me this year. And not only was it really expensive, but it was really difficult to even figure out how much I owed the government, right? Because if you're exchanging cryptocurrency somewhat regularly, you don't need to be a day trader, but over the course of a year, if you on average make a trade every week or a series of trades every week, and then you got to do all the math for that, it's very difficult. Now, some private sources, are attempting to come up with ways to ameliorate this. I think Coinbase is working on this. So I've heard anyway. And I've heard of others, I can't recall any of the names right now, that are working on providing efficient accounting for your crypto exchanges, right? So yeah, maybe one problem will end up getting out of the way sooner or later. But there's still this problem of monitoring. And, the government's got to take this very seriously, because when you want to maximize the revenue that you're collecting, you need to make sure that it's easy to collect that revenue. And so if if before the point of sale of capital assets was where the government was collecting revenue and it finds that it can no longer efficiently collect revenue from that place, then it's going to have to move somewhere else.
Consumption tax.
Yeah, well, that's ultimately you can't avoid, if you have a consumption tax, you can't avoid the consumption tax, at least not easily. Firms, there's more oversight with firms. But it's a real challenge, right? Taxation depends on you moving through intermediaries that are relatively more centralized.
Yeah.
Than if you're just exchanging randomly with other people. But now that in the crypto space, exchanges can move directly between party A and party B. The government can try to work through exchanges to have oversight over the transactions, but then there's problems of anonymity.
Yep. And there are decentralized exchanges coming too, right? So there are decentralized exchanges that are completely don't have a central authority. They're similar to Bitcoin in the fact there's nobody to lean on in terms of regulatory.
Yeah. So this is radically changing the face of governance. I mean, or in other words, the blockchain is itself a system of governance. So we're seeing radical transformation in how people are creating rules amongst themselves, and ultimately, that's where rules come from. In the beginning, is we have norms, we have ways of dealing with one another, then we engage in business and we try to be explicit, a contract, verbal or written, and we move forward with that. Blockchain is giving us ways to very efficiently deal with these sorts of problems that we've been dealing with since the beginning of time, and it's doing it in a way that's hard to monitor, and it's doing it in a way that's hard to find somebody to monitor for you if you're the government. So these problems are real, and the governments that most quickly adapt and find ways to deal with this, they're going to be leaders in terms of policy, and I think they'll also be leaders in terms of their ability to collect revenue, to work with business, and so forth, to just accept, the level of autonomy that's demanded in the modern economy.
Here's where I think all this is going, and this is just my personal wild opinion, but I'd love to hear your feedback, and that is that these new instruments, the blockchain distributed applications, these protocols, is the way we issue currency, the way we govern, the way we exchange, all that. Once it goes decentralized, the role of government will change. First, I don't think you're going to see fractional reserve banking anymore in a traditional sense. There's no more reason for a demand deposit account, so there's no more reason to have those. You're not going to have reserves on which to lend, right? But as that disappears, I think the role of government will become more of a enforcement to make sure that off-chain, off-blockchain activities and reactions actually match what's coded on the blockchain, because the blockchain's immutable. You can set the rules for the smart contracts, for the agreements for money, but the real world doesn't follow computer rules, right? The real world kind of has this tendency to go off and veer on its own. So I think that the primary role of government might actually wind up switching more to just becoming the enforcement mechanism to say, hey, what happens on this blockchain, we make sure that that's enforced in the real world.
Yeah, so actually you're intuitively pointing to an insight from public choice literature and law and economics, right? Most laws most rules are privately run, right? Like the HOA, the government doesn't really have much to do with that. Most agreements that you make with people, the government doesn't have anything to do with that. Most legal disputes are resolved privately amongst corporations, right? Then there's a whole realm of private law, and there's a research field of private law. Now, private law in modern society, ultimately, enforcement, there's many layers of enforcement mechanisms from the private rule set all the way up to, suing at the federal level or the state level, where there's actually going to be enforcement, and there is true coercion in terms of the use of force, violence, in order for administering the law. But most law is executed way farther down that hierarchy, so that you're actually resolving conflicts without the use, because it's really expensive to resort to using the formal legal system in terms of against principalities, power exercise, power dependent on violence and exercise. Most people don't want to run to that. Most people don't want the people that they're involved with in business to think, wow, the moment that there's a problem, you're going to run to the authorities and sue me. This is so most conflicts are resolved privately. The blockchain is just another layer of this, and we even see at the private, still at the private level, means of increasing security. So RFID, for example, being used with blockchain technology. We're automating this process, and we're doing something that both parties feel more secure in using. Blockchain's allowing us to move away from third-party intermediaries that would, again, drive up costs, be able to collect revenue from serving there, and also maybe even could collect some rents in terms of defining the way that exchanges are made or relationships are formed. So that's all at the lower level. Now the government is going to do the same thing it always has, of course. At the judicial level, hopefully the quality of our judicial systems remain intact, and it does a job of enforcing the law, and of course politicians are going to be interested in seeing how they that enables transactions, legislation that accomplishes certain goals that they want, whatever those goals are, and they could be many different things, right? But at the end of the day, I think blockchain is just simply going to move. It creates more enforcement mechanisms. It creates more levels for there to be a solution without going to the final resort. Now, that said, every system can be bugged. Every system can has flaws built into it, and that we have to learn to work around and develop the system as we move forward, because there's always going to be baddies out there who, thieves, anybody else who want to break the rules in the system or use the existing structure of the system to benefit themselves at the cost of others. Right? This is a real problem, and that's never going to go away. And that's why we need law, and that's why we need a legal system that evolves but is based on past precedent. In that sense, these are challenges that, again, competition in markets are going to have to deal with. Just in the same way that when online banking arose, no shortage of problems could exist, and banks have very quickly learned to monitor usage for fraud.
Yeah, and that brings the kind of the next point of evolution of sound money is, today our fiat dollars is commonly known that not only it's the most counterfeited currency in the world, American fiat dollars, it's also the most that's used for criminal activity, fiat dollars, and supposedly every single currency has some type of drug paraphernalia or drug microorganisms on it because it's used for these kind of nefarious activities. But digital currency, it really helps us to really close that trust gap, close the gap of nefarious activities with how manipulating currency or using currency in different ways. How do you think blockchain and the evolution of money kind of helps in that? I know that's a tough, larger question, but
there's been some good research out there already. One of the first places that cryptocurrency actually was valuable to use was on the dark web for people who engage in transactions. They want to hide their identity. So there, again, new technology is not going to do away with human drives. Just not going to do it. So the dark web is a place where people go to hide their activity, where everything is very difficult to monitor. And there are places like Amazon on the dark web. And there's been some good research on this, actually. Norgard, Walpert, and Hardy. There's a couple papers out there with some mix of those last names. They've done some work that's gotten some attention on the dark web and the mechanisms of the dark web and developing trust. And I think these sorts of issues deserve attention by people who are looking to the future. What is the future of cryptocurrency? First, look at where it came from. So that's to say, we're not going to avoid the drug issue. Counterfeiting. People are going to try to break the cryptocurrency systems, and we actually see in small blockchains, some attacks are able to successfully take over a majority of the nodes.
Yep.
Large systems, computationally, it just shouldn't be possible. I don't know, maybe with the rise of quantum computing or things that I just don't understand, that'll change. But, you know, right now, it would be it's hard to imagine something like the Bitcoin blockchain being taken over and then there being new Bitcoin generated that's outside of the rule set. So, you know, cryptocurrency definitely helps with issues of fraud. Now, we can also imagine a world, though, where cryptocurrency circulates. And so this, you know, again, there's always going to be new opportunities for fraud. So if somehow we create cryptocurrency, physical units of cryptocurrency, where the ownership of the cryptocurrency exists within some chip or something in the currency. I believe these exist already. You know, you could correct me here if I missed something. But you know, those are ripe for fraud, because if you have something that looks like a Bitcoin note or something that can electronically be identified, you know, maybe there are ways around that. When you do, if you have users that aren't careful, right, you're always going to have users that can be taken advantage of if they're not careful. You know, it's worth mentioning, thinking about fiat money, because everybody, I think, there's not much love for fiat money in modern society. We all use it, but we all have to use it. You know, but it does function. Yeah, we all accept fiat money. We were told we have to, and even if we lost the law that said we had to, I bet it would take a long time, you know, for people to move away from the dominant currency. If tomorrow the government said, you know, you don't have to use the dollar, you know, you could use whatever currency you want, I think a lot of businesses would still be happy to use dollars. And I think that the Federal Reserve, if it wanted to maintain that position, would be very careful about how to manage the money stock. You know, so these are sort of issues that come up. I think they can be confusing, especially when you have a predisposition about what's going on. But that said, right, competition rules the day, and there's a heck of a lot of competitors out there.
Yeah, well, you make an interesting point, because I think there was about a year ago, and I forget exactly where I read it, but there was a question of what could challenge even the U.S. dollar, its status as the reserve currency of the world, and it wasn't the fact that, you know, although in the libertarian circles we kind of like to bash fiat like a baby seal, right, as much as we can. At the same time, what's the alternative? Right. I mean, you have instability in Europe, so you're not sure if the euro will survive. I think they were talking about the yuan itself being, the renminbi being manipulated by its government to no end. And they didn't even postulate there was enough supply to meet the reserve currency the denominations needed. So, I mean, are there any alternatives? I think what people kind of are interested in conflating this now with the rise of Bitcoin is they're saying, oh, well, Bitcoin's going to go to the moon, it's going to take over everything. But at the end of the day, I mean, as soon as something better than Bitcoin comes along, that's what would make it collapse, and all the value would evaporate from it. I mean, people measure it today as like, oh, it's number one in market cap, but that's not net realizable value, right? That's all the Bitcoin in circulation at the current price. If everybody went and tried to realize that price, you'd see it collapse to zero, and it wouldn't be realized, right? So I think there's some interesting little injunctions, and I kind of went all over the place there. But what are your thoughts on the long-term survivability of something like Bitcoin, on some of these fluff coins, first generation?
Well, so you mentioned, and you know, again, you know, these coins, Bitcoin and coins like Bitcoin provide a service, and that, in some sense, you know, you could think of that as their backing. They provide value, right? All the money needs to have is somebody values it in order to use it. Now, sorry, I lost track of what direction you're going with the question. You say, not only, you know, what do we think about the future of something like Bitcoin as compared to maybe other competitors out there? Well, we'll see, right? We just saw a big bubble. I mean, people don't realize, I think, what we just experienced in the cryptocurrency market was like a micro NASDAQ. You know, it's a smaller market, so it's more volatile. But when you see the total capitalization in the market increase by 3 or 4 times in a matter of a few months, you know, that's a bubble. And I think what we really want to do is think about what the role of bubbles are and then where that's going to move us. So I don't know what the future of Bitcoin is. I think it's the first mover, and it's hard to beat a first mover. Doesn't mean it's impossible to beat a first mover, but it's hard. And we even see this with Bitcoin Cash. They increased their block size so that they could more efficiently handle transactions. Many truly, deeply believe that Bitcoin Cash is the more efficient cryptocurrency. And Bitcoin has moved to like an adjacent system for clearing accounts to increase efficiency with their Lightning Network, which they're still in. I don't know if they've moved out of beta phase yet, but it's not clear who the winner is going to be, and it's not clear how easily people are swayed to move from one cryptocurrency to another. Even if it looks like the facts support one cryptocurrency, as I'm telling you here with the case of Bitcoin Cash versus Bitcoin, right? We have two competing systems. We have the Lightning Network now, and we have Bitcoin Cash. And a lot of people are betting. The market's saying, well, Bitcoin plus the Lightning Network is going to be a success. This is what it looks like. People have enough faith to have maintained that. And so Bitcoin's first mover advantage, I think, is playing at least a part in people's valuation in that respect. Now, what happened with bubbles? I mentioned bubbles earlier in the economic role of bubbles. So Jason Ponce has done some really interesting work on bubbles. He is involved in research on blockchain and governance. But his research and technology supports the point, says, well, bubbles play a role in attracting money to investments, new investments, and we don't know what they're worth. So in economic theory, one thing is very clear. We don't know what the value of something is unless we're in a highly competitive market that has reached something like equilibrium. So we have a highly competitive market in the crypto space, but it's very early. We don't know what the trajectory is. We don't know who the winners are going to be. And there's a lot of uncertainty about what the functionality is. Everybody says blockchain is going to be big, but most of us don't know how blockchain is going to be big. We can make some guesses. It looks like something like, localization of decision-making, property rights, governance, that's going to play a big role. It looks like it could play a role in money, and in many places it will play a role in money in developing economies. It could, so we see a lot of opportunity, and therefore we saw a lot of money flow into the market. And then we saw a lot of money flow out of the market, but we still see valuations of most of the major cryptocurrencies substantially higher than they were before the last bubble.
Yeah. And speaking of developing nations and developing economies too, I think that's one of the things that's going to drive their adoption a lot more is when we do have a real, quote unquote, stable coin, something like what we're developing. And I'm not trying to push our platform here and tokenize this a little, but maybe a little bit, but if you're living hand to mouth or you're living in a developing economy, the last thing you want is to see your money drop in value 3-4 times in a month. So that volatility does scare off some folks. I think that's where you're going to see kind of like the stable coins or the less volatile coins maybe start driving a little bit more adoption. Now, in our case, even though we're all in a completely rational market with the people actually treating it rationally. So an efficient market hypothesis, basically, looking at it, they would say, okay, well, there's $1 worth of assets. Maybe because of the liquidity premium, I'm willing to pay $1.20 for it, or because it's a stable store of value, I'll pay $1.25 for it now because I know it'll always be worth, quote unquote, $1 worth of purchasing power over time. But there are some scenarios in which people might drive the price of that up to $7-8. Like, what is that? Just a faction of the irrationality of the market right now, like the frenzy, or is that something just the lack of competition? Where is that from a behavioral economic standpoint? I'm kind of curious.
So this is the point that I'm making, is that competition with new investments drives a lot of investment in. So you can imagine, right? Like if you have a race, everybody races a mile, and we have 30 runners, and there's only going to be one winner, only one second place, one third place, and everybody's going to say, wow, they were good. It's not like we had a running bubble, but when we get a new technology in place, and suddenly there's this awareness, and that's what we're at right now. We're at a state where there's awareness that there's great opportunity, and that awareness is evidenced by so many major corporations moving in, not just a number of startups, but major corporations, banks, right? I was watching this morning, ING was saying that they're long blockchain. They're involved in developing not just blockchain, but developing business, internal business organization that can allow them to take advantage of blockchain. When you see that regularly on the news, right, they're not the only ones saying this. They're not the only ones getting involved. We know that we have reached a critical mass in awareness that blockchain is a technology that's going to matter. To what extent it matters, we'll find out. Some people are saying it's bigger than the internet. Some people are saying, well, it's not quite as big as the internet. Some people are saying, it doesn't really matter, but they seem to be a minority. So, we don't know, but we've reached this critical mass. Now, once we reach the critical mass, that's like the starting line, right? Maybe some people who really got in early, they got ahead of everybody else. But we can imagine this metaphor of the race is something like, now that everybody's aware, it's hard to go up to somebody in society and say, have you heard of blockchain? It's hard for them to say no. I have people who say, I don't know what it is, but I've heard of it. But I don't think I met anybody that said, I've never heard of blockchain. Now we're at that point, everybody's sprinting. Right? Or in other words, money's flowing in terms of investment. And we saw the bubble in the cryptocurrency market, but I don't think this is going to be the only blockchain bubble. And I don't think bubbles are necessarily bad. And so we see a lot of companies trying to get value from this, and we see investors happy to try to extract value from blockchain or invest in companies that are themselves investing in blockchain. Right? So we see this feedback effect. We don't know who the winners are. We don't know what the big uses are going to be, and we don't know if maybe it's a bubble, maybe it's the first in a few stages of massive ratcheting up of investment in blockchain.
Yeah, I think that's. I'm sorry. Go ahead.
But so yeah, there's going to be swings in prices. There's going to be changes in capital, total capital valuation. We'll see where it goes.
Yeah, no, I mean, there's going to be, I think, a couple more little bubbles. I in the talks that I've given and the conferences I go to, you're still able to find some folks that don't know much at all about blockchain cryptocurrencies. Like you said, they've heard it on the news. I mean, the circles that we tend to congregate in, everybody's aware of it because we're all been bitten by the bug and we're all excited about it and all this new world stuff. So it's easy to remember. Or easy to forget that there's still a great chunk of the people out there that don't really understand what's going on in this space and what the possibilities are. I mean, people are waking up though, as some of the guys say. The virus is spreading or the contagion is spreading. This morning, China even posted their official assumption of saying it's going to be about 10 times the valuation of the internet, but in terms of the value that blockchain brings and distributed ledgers bring to the market. So I think, yeah, there's some folks, but right now, a lot of that investment you saw, they were going into these ICO vehicles, which is a fundraising mechanism where people would print up these little pools of scarcity, lock 40% away in a vault somewhere, go try to build a market and sell the other 60% to bring up the price and get a recognized price, just so they can come back later, pull that 40% that was in the vault and go sell it, dump it, and just kind of walk away and drink Mai Tais on the beach the rest of their life. So, and there were willing participants on the investor side that would come in and buy them in a pre-sale at a discount, knowing full well that they would get 100% liquidity and sell them at the full price on launch day. So I think you saw a lot of money flowing into it, but that was kind of a skewed bubble because people were just making money hand over fist, creating these little pools of scarcity. I mean, even Doggy Coin, the joke, the guy created it out of a joke, and it took off and had a big valuation. So I think there's still a couple of more bubbles, or you could say stepping stones to really hit that start line you're talking about. There's still some hesitancy on the mainstream. People are still kind of looking back and waiting to see what happens. But yeah, I mean, the money is starting to flow into it with real investment now, not just pump and dump ICOs, and that's exciting to see.
Yeah, the story about money that I told, evolution of money, in that story, the person who created money, because money is a concept, and we took what we had and we just added some new category to it. Said, well, this is a thing that we exchange, and it tends to exchange well, so we give it its own special place in our mind, own special category. Well, the person or persons, the community from which money arose, did not need to be intentional about creating money in the sense that they knew they were creating this category of thing. It could have been totally by accident, but because it's the profitable thing to do, then money won out. And in fact, I am predisposed to think that's exactly how early monies arose. You know, there are other uses, other stories that that might facilitate some parts of money, but in terms of like a market commodity money, you don't need agents to be especially intentional about it. You just need them to have accidentally stumbled upon it, and then you have the concept of money. Then they recognize what money is, and money takes off. I think the same way, right? People are doing a lot of different things right now. We're not sure, again, which ones are going to be successful. I think that investors and consumers, they're not dumb. They're not just acting randomly. They probably like cryptocurrencies whose quantity is governed by a rule, one way or another, right? Maybe it's a rule about the assets that are on the blockchain. Maybe it's a rule about the speed at which quantities, the quantity of monies increase. Right? And we see, right, what two cryptocurrencies seem to have taken the day. Well, Bitcoin, which has a limited growth rate, and Ripple, which has in the short run a limited upward trajectory, and in the long run actually has a downward trajectory.
Yeah, no, and you've written some good subjects. I recognize some of what you're talking about there from your commodity money paper as well. So I will put a link down below in the description to some of your papers and research papers. There's some really interesting reading. So and never been more interesting to be in monetary theory than right now, at least in our last few generations, I think. Right?
Absolutely.
So,
yeah, you know, you think about cryptocurrency and blockchain generally, just in closing, thinking about what's a nice metaphor. In the cryptocurrency market, gold is a really nice metaphor because gold is a commodity, and actually George Selgin refers to cryptocurrency as a synthetic commodity. Right? It's this limited number of assets that can be divided and bought and sold. It looks a lot like a commodity, but its use is something different, right? It's this mysterious thing. But gold, the price of gold tended to converge toward a long run price. And you can look at some paper, Masmander and Wood actually wrote a paper, the name's leaving me right now, but where they argue that the price of gold tended to be mean reverting. And they're not the only ones that think that. There's a lot of people that they look at the price of gold and say, well, except when Great Britain left the gold standard during the Napoleonic Wars, except when you might have some short periods of destabilization, usually due to government intervention. The price of gold was relatively stable because if you had more stuff to buy with gold, then the value of gold went up. People produced more. Right? If you demanded more gold, price of gold can't remain elevated very long without new quantity coming in. We even saw this in the recent boom with gold, was that there's a huge increase in the value of gold in 2007 to 2010, 11-ish. And we saw the quantity of gold increase substantially, and the price didn't remain, far and away, and it didn't keep going up. It just sort of stabilized. This is what commodities do, especially if you have a persistent use of it, say using it as a means of exchange. So that, again, that same mechanism's at work. How and where it's going to come out and what we're going to see win the day on that, I'm not sure. But markets have been very good at providing stable money simply on their own.
Yeah, no, and you nail it on the head. I think the markets are the best means to do it. And again, I'm going to plug Turbadium one more time, but that's why we're trying to capitalize on the markets to bring in that stability rather than shut them out like some algorithmic or centralized stablecoin models are trying to do. So trying to engineer an instrument that tells the market what it's worth is an interesting Interesting theory, but I don't think it's going to work out very well in the end. I mean, as you mentioned with gold, that happened. I mean, you still buy what an ounce of gold bought you in Roman times is still what an ounce of gold buys you today, right?
It does. No kidding.
All right. Well, thank you, Dr. Jim. Thanks, Scott, for hosting. We got some great guests coming up this month as well. Be sure to like, comment, and subscribe on this video, and we'll see you next time on Tokenize This.